Welcome back to Boni's Life, your trusted source for fact-based crypto market analysis. I'm Boni, and today we're diving deep into one of the most devastating crypto market events we've witnessed this year. If you've been watching the markets over the past 24 hours, you know exactly what I'm talking about. We've witnessed a catastrophic crypto crash that triggered $19.4 billion in liquidations. That's a staggering 4,284% increase from normal levels. Bitcoin has plummeted 8.1% to $111,795, while Ethereum has been absolutely decimated with an 11.6% drop to $3,835. But here's what makes this crash particularly significant. It wasn't driven by crypto-specific news or regulatory concerns. Instead, we're looking at a perfect storm of macroeconomic factors, geopolitical tensions, and over-leveraged positions, creating a liquidation cascade that has sent shockwaves through the entire digital asset ecosystem. Today, I'm going to break down exactly what happened, analyze the fundamental and technical factors at play, and most importantly, give you the key levels and trading strategies you need to navigate the next 24 to 48 hours in this extremely volatile environment. Before we dive in, if this kind of detailed fact-based analysis helps you make better trading decisions during these turbulent times, smash that like button and hit subscribe with notifications on. We're building a community of informed crypto investors here, and your engagement helps us reach more people who desperately need this information right now. Let's start with the numbers, because they tell an absolutely devastating story that goes far beyond a typical market correction. The total cryptocurrency market capitalization has crashed by 9% in just 24 hours, falling to $3.85 trillion. To put this in perspective, that's approximately $380 billion wiped out in a single day, more than the entire GDP of many countries. Bitcoin, despite being considered the most stable cryptocurrency, has fallen 8.1% to $111,795, representing a loss of nearly $10,000 per coin from recent highs. But Bitcoin's decline pales in comparison to what we've seen across the broader altcoin market. Ethereum has been absolutely crushed, dropping 11.6% to $3,835, breaking below the psychologically critical $4,000 level and that many traders considered strong support. The carnage in altcoins has been even more severe, with Solana crashing 14.7% to $187, Dogecoin plummeting a devastating 21.6% to just $0.196, and Cardano falling 17% to $0.677. The trading volumes tell us this isn't just retail panic selling. We're seeing massive institutional participation. Bitcoin alone has generated $191.5 billion in 24-hour volume, while Ethereum hit $111.8 billion. These are extraordinary numbers that confirm major players are actively repositioning their portfolios in response to changing market conditions. But here's where the story gets truly alarming. The liquidation data from CoinGlass shows $19.4 billion in forced liquidations over the past 24 hours. This represents a mind-boggling 4,284% increase from normal levels. To put this in context, we typically see around $400 to $500 million in daily liquidations during normal market conditions. What we're witnessing is a complete breakdown of leveraged positions across the entire crypto ecosystem. The market sentiment indicators are painting an equally grim picture. The Fear and Greed Index has plummeted to just 28, firmly in fear territory. The long-short ratio has flipped dramatically, with 52.08% of traders now betting on further declines compared to just 47.92% maintaining bullish positions. This kind of sentiment shift often precedes extended periods of volatility and uncertainty. Perhaps most concerning is the average RSI reading of 28.92. which indicates severely oversold conditions across the entire cryptocurrency market. While oversold conditions can sometimes signal buying opportunities, in the context of such massive liquidations and negative sentiment, they more often indicate that the selling pressure may continue until these over-leveraged positions are fully cleared from the system. So what exactly triggered this market catastrophe? The answer lies in a perfect storm of interconnected factors that created a cascade effect throughout the global financial system. The primary catalyst appears to be escalating geopolitical tensions, particularly surrounding US-China trade relations and broader global economic uncertainty. When geopolitical risks spike, institutional investors typically engage in what's called risk-off behavior, moving capital away from speculative assets like cryptocurrencies and into traditional safe havens such as government bonds and gold. This risk-off sentiment has been amplified by concerns about global economic growth, inflation pressures, and central bank policy uncertainty. The cryptocurrency market, despite narratives about Bitcoin being digital gold, continues to behave more like a risk asset during periods of extreme stress. This correlation with traditional risk assets becomes particularly pronounced during crisis periods, as we're witnessing today. The second major factor is the massive amount of leverage that had built up in the cryptocurrency derivatives market. According to CoinGlass data, open interest across crypto derivatives had reached $155.33 billion before this crash. When prices began falling, automated liquidation mechanisms kicked in, forcing the sale of leveraged long positions and creating additional downward pressure on prices. This leverage cascade effect is particularly devastating in cryptocurrency markets because of their 24/7 nature and relatively lower liquidity compared to traditional financial markets. Unlike stock markets that have circuit breakers and trading halts, crypto markets continue operating around the clock, allowing these liquidation cascades to continue unabated until all over-leveraged positions are cleared. The third contributing factor is the technical breakdown of key support levels that many traders had been relying on. Bitcoin's break below $115,000, Ethereum's fall through $4,000, and similar breakdowns across major altcoins triggered algorithmic selling from both institutional and retail traders who had set stop-loss orders at these levels. What makes this situation particularly dangerous is the interconnected nature of these factors. Geopolitical uncertainty triggers risk-off sentiment, which causes initial selling pressure. This selling pressure breaks technical support levels, which triggers stop-loss orders and algorithmic selling. The increased selling pressure then forces liquidations of leveraged positions, which creates even more selling pressure, and the cycle continues until either buyers step in at significantly lower levels or the over-leveraged positions are completely cleared from the system. The cryptocurrency community's response to this crash has been notably divided, with experts offering varying perspectives on both the causes and potential outcomes. Peter Brandt, the legendary trader with decades of experience across multiple market cycles, has maintained a cautiously optimistic long-term outlook despite acknowledging the severity of the current situation. Brandt continues to believe that Bitcoin could eventually reach $185,000 if historical cycle patterns hold, but he's also acknowledged that we may be entering uncharted territory where traditional cycle analysis may not apply. Stock Money Lizards, a respected technical analyst with a large following, has characterized the current decline as a necessary shakeout that could ultimately strengthen the market by clearing out weak hands and over-leveraged positions. However, even bullish analysts like Stock Money are acknowledging that the technical damage is significant and that recovery may take longer than initially anticipated. From an institutional perspective, the data remains surprisingly positive despite the short-term carnage. Recent surveys from State Street Global Advisors show that 69% of institutional investors still plan to increase their Bitcoin and cryptocurrency allocations over the next several years, with target allocations reaching 16% by 2028. This suggests that while institutions may be reducing risk in the short term, the long-term adoption thesis remains intact. However, institutional behavior in the immediate term tells a different story. Bitcoin exchange balances have decreased by 5.51 thousand BTC to 2.19 million, suggesting that some large holders are moving coins off exchanges, potentially in preparation for long-term holding. This could be interpreted as either institutional accumulation at lower prices or simply risk management in an uncertain environment. The derivatives market data provides additional insight into institutional sentiment. The fact that 52.08% of traders are now positioned short suggests that even sophisticated market participants expect further downside in the near term. This is a significant shift from the typically bullish sentiment that has characterized the crypto market over the past several years. What's particularly noteworthy is the speed and magnitude of this sentiment shift. Just weeks ago, many of these same analysts and institutions were predicting new all-time highs for Bitcoin and Ethereum. The rapid reversal in sentiment suggests that the underlying factors driving this crash are more serious than typical market corrections. From a technical analysis perspective, the damage inflicted on cryptocurrency charts over the past 24 hours is substantial and will likely have lasting implications for market structure. Bitcoin's current price of $111,795 represents a critical juncture for the world's largest cryptocurrency. The break below $115,000 has confirmed a short-term bearish trend, and the next major support level to watch is around $108,000. This level represents both a psychological round number and a technical support zone based on previous price action. If Bitcoin fails to hold this level, the next significant support doesn't appear until the $100,000 psychological level, which could trigger another wave of panic selling. On the upside, Bitcoin faces immediate resistance at the $115,000 level it just broke below, followed by stronger resistance around $120,000. The 20-day moving average, currently around $116,500, will also act as dynamic resistance for any recovery attempts for Bitcoin to signal that the worst of this decline is over. It would need to reclaim and hold above $115,000 on significant volume. Ethereum's technical picture is even more concerning. The break below $4,000 represents a significant psychological and technical breakdown. Ethereum is currently trading at $3,835, and the next major support level appears to be around $3,600. Below that, there's a significant support vacuum until approximately $3,200, which could result in rapid price declines if selling pressure continues. The Relative Strength Index, RSI, for both Bitcoin and Ethereum is showing oversold conditions with readings below 30. While oversold conditions can sometimes indicate buying opportunities, in the context of such massive liquidations and negative sentiment, they more often suggest that the selling pressure may continue until these conditions are resolved. Volume analysis reveals that this decline is occurring on exceptionally high volume, which gives more credibility to the price action. High volume declines are typically more significant than low volume moves and suggest genuine shifts in market sentiment rather than temporary liquidity issues. The broader altcoin market is showing even more technical damage. Solana's 14.7% decline has broken multiple support levels, while Dogecoin's 21.6% crash has pushed it back to levels not seen in months. This widespread technical breakdown across the entire cryptocurrency ecosystem suggests that this is not just a Bitcoin or Ethereum-specific issue, but rather a systematic repricing of risk across all digital assets. Looking ahead to the next 24 hours, there are several critical technical levels that will determine whether this crash continues or if we see some stabilization. For Bitcoin, the key level to watch is $108,000. A sustained break below this level on high volume would likely trigger another wave of selling and could push Bitcoin toward the $100,000 psychological level. Conversely, if Bitcoin can hold above $108,000 and begin to show signs of stabilization, it might indicate that the worst of the selling pressure has been absorbed. The bullish trigger for Bitcoin would be a decisive reclaim of $115,000 on significant volume. This would suggest that buyers are stepping in and could lead to a relief rally back toward $120,000. However, given the current market sentiment and the magnitude of the liquidations, such a recovery seems unlikely in the immediate term. For Ethereum, the critical support level is $3,600. A break below this level could trigger rapid selling toward $3,200, as there are relatively few support levels in between. The bullish trigger for Ethereum would be a reclaim of $4,000, but this would require a significant shift in market sentiment and substantial buying pressure. Volume will be crucial in confirming any moves in either direction. Low volume bounces are likely to be short-lived in this environment, while high volume breaks of support levels could lead to accelerated selling. Traders should be particularly cautious of any moves that occur on low volume, as they are more likely to be false signals. The weekend effect could also play a significant role in the next 24 to 48 hours. Cryptocurrency markets typically see reduced liquidity on weekends, which can lead to more volatile price action. In the current environment, this reduced liquidity could amplify any moves in either direction, making risk management even more critical. Based on the current technical and fundamental analysis, I've identified 3 potential scenarios for the cryptocurrency market over the next 24 to 72 hours, each with different probability assessments and implications for traders and investors. Scenario 1. Continued liquidation cascade, 65% probability. This is my base case scenario given the magnitude of the current liquidations and the negative sentiment pervading the market. In this scenario, the selling pressure continues as more over-leveraged positions are forced to close and technical support levels continue to break down. The key triggers for this scenario would be Bitcoin breaking below $108,000 and Ethereum falling below $3,600. If these levels fail, we could see Bitcoin decline toward $100,000 and potentially as low as $95,000, while Ethereum could fall to $3,200 or even $3,000. Altcoins would likely see even more severe percentage declines, with many potentially losing 30 to 50% of their current value. The drivers for this scenario include continued geopolitical uncertainty, further institutional risk-off behavior, and the mechanical nature of liquidation cascades. Once these cascades begin, they often continue until all over-leveraged positions are cleared from the system regardless of fundamental value. Scenario 2. Stabilization and consolidation. 25% probability. In this scenario, the market finds a temporary bottom around current levels and enters a period of sideways consolidation as it digests the recent selling pressure and liquidations. This would require the liquidation cascade to slow significantly, and for some institutional buyers to step in at these lower levels. For Bitcoin, this would mean establishing a trading range between $108,000 and $115,000, while Ethereum would consolidate between $3,600 and $4,000. This scenario would be characterized by high volatility within these ranges but without the sustained directional moves we've seen over the past 24 hours. The catalysts for this scenario would include a slowdown in liquidations, some positive news flow to offset the current negativity, and evidence of institutional accumulation at these lower levels. However, given the current sentiment and the magnitude of the liquidations, this scenario seems less likely in the immediate term. Scenario 3. Sharp relief rally. 10% probability. This is the lowest probability scenario but worth considering given the severely oversold conditions across the cryptocurrency market. In this scenario, a significant positive catalyst or a sudden shift in market sentiment triggers a sharp relief rally that catches short sellers off guard. The technical triggers would be Bitcoin reclaiming $115,000 and Ethereum breaking back above $4,000, both on high volume. If this occurs, Bitcoin could rally back toward $120,000 to $125,000, while Ethereum could target $4,200 to $4,500. However, any such rally would likely be viewed as a relief bounce rather than a resumption of the long-term uptrend. The catalysts for this scenario would need to be significant, such as major positive news regarding geopolitical tensions, unexpected institutional buying, or technical factors like a massive short squeeze. Given the current environment, such catalysts seem unlikely, which is why this scenario has the lowest probability. Given the current market conditions and the high probability of continued volatility, trading strategies need to be adapted for this extreme environment. Risk management becomes even more critical when markets are experiencing the kind of liquidation cascades we're seeing today. For conservative traders, the best approach in this environment is to wait for clear signs of stabilization before entering any new positions. This means waiting for the liquidation cascade to slow, for technical support levels to hold, and for some positive momentum to return to the market. Conservative traders should also consider reducing position sizes significantly until market conditions stabilize. Aggressive traders who want to take advantage of the volatility should focus on short-term scalping strategies with very tight stop losses. The key is to look for bounces off major support levels, but be prepared for these bounces to fail quickly. Volume confirmation is crucial. Any moves that occur on low volume are likely to be false signals in this environment. For long-term investors, this crash could represent a significant buying opportunity, but only for those with strong risk tolerance and the ability to withstand further declines. Dollar cost averaging strategies could be effective, but investors should be prepared for the possibility that prices could go significantly lower before they recover. Position sizing is critical in all scenarios. Given the extreme volatility and the potential for further liquidation cascades, no single trade should represent more than 1 to 2% of total portfolio value. Stop losses should be set wider than normal to account for the increased volatility, but position sizes should be reduced accordingly to maintain the same risk level. The current market conditions serve as a stark reminder of why proper risk management is essential in cryptocurrency trading and investing. The magnitude of the liquidations we're seeing demonstrates what can happen when traders become over-leveraged and fail to properly manage their risk. The most important principle in the current environment is to never risk more than you can afford to lose completely. The cryptocurrency market has shown repeatedly that it can move much further and faster than most people expect, and the current liquidation cascade is a perfect example of this principle in action. Position sizing becomes even more critical during crisis periods. Many of the traders who were liquidated over the past 24 hours were using excessive leverage or had position sizes that were too large relative to their account size. In volatile markets like cryptocurrencies, position sizes should typically be much smaller than in traditional markets. Stop losses are essential, but they need to be set appropriately for the current volatility levels. Setting stops too tight in this environment will likely result in being stopped out of positions that might ultimately be profitable. However, stops that are too wide can result in unacceptable losses if the market continues to decline. Diversification across different assets and strategies can help reduce risk, but it's important to remember that during crisis periods, correlations between different cryptocurrencies tend to increase. This means that diversification within the crypto space may not provide as much protection as expected. As we look ahead to the next 24 hours, several key factors will determine the direction of the cryptocurrency market and whether this liquidation cascade continues or begins to stabilize. The most important factor to watch is the pace of liquidations. If the $19.4 billion in liquidations over the past 24 hours begins to slow significantly, it could indicate that the worst of the forced selling is behind us. However, if liquidations continue at this pace or accelerate, we could see further significant declines across all major cryptocurrencies. Technical levels will be crucial in determining market direction. Bitcoin's ability to hold above $108,000 and Ethereum's defense of $3,600 will be critical for preventing further cascading declines. Breaks below these levels could trigger another wave of selling and push prices significantly lower. Market sentiment indicators will also be important to monitor. The fear and greed index, long-short ratios, and funding rates will all provide insights into whether the current negative sentiment is beginning to stabilize or if it's continuing to deteriorate. Global macroeconomic factors will continue to influence cryptocurrency markets. Any developments regarding geopolitical tensions, central bank policies, or broader financial market stability could have significant impacts on crypto prices in either direction. Your key levels to watch over the next 24 hours are Bitcoin support at $108,000 and resistance at $115,000, and Ethereum support at $3,600 and resistance at $4,000. Volume confirmation will be essential for any moves in either direction. Remember, in volatile markets like this, risk management is everything. Don't risk more than you can afford to lose. Use appropriate position sizing and always have a plan before entering any trade. The current market conditions are a reminder that cryptocurrency markets can be extremely unforgiving to those who don't respect the risks involved. That's all for today's crisis analysis. If this breakdown helped you understand what's happening in these chaotic markets, please hit that like button and subscribe for more fact-based crypto analysis during these critical times. Drop a comment below and let me know how you are navigating this market crash. Are you seeing this as a buying opportunity, or do you think we have more downside ahead? Your insights and experiences could help other members of our community. I'll be monitoring the markets closely over the weekend and will update you immediately if there are any significant developments. Until then, trade safe, manage your risk carefully, and I'll see you in the next video.